on the table here, Larry. Let me just point out that without housing, third quarter GDP was 6% annualized growth. And you have to remember that going back into the second quarter, Nouriel and others were saying third quarter was only going to have 2% growth. So these pessimists have been way, way wrong on the low side, and they've continually been blown out of the water by stronger than expected data. And I don't care what the weekly chain store sales are saying and all of these things. We've constantly had revisions upward. We've constantly had better news. And I think all you have to do is go outside. You can't get a parking spot at the mall. You have to wait in line to get a table at a restaurant. You get middle seats on the airplane. There's no evidence that this economy is slowing down. Now, one of the things I'd like to point out is that the Treasury curve is inverted, but not the risk curve. And I think the Treasury curve is inverted because the Federal Reserve buys Treasury bonds when they inject money into the economy. Banks that are having some credit issues, and most of those money center banks are a little worried right now, they're buying Treasury bonds. And so what you have is this big demand for treasuries which don't eat up any capital, and I think that's inverting the curve.
All right, what do you say, just to follow up, we'll get Nouriel to respond. What do you say to a chap like Mark Perry of the Michigan Business School? He was on the other night. We looked at the M1 money supply. Lord knows I haven't looked at that thing in years.
Right.
But it's interesting. It hasn't moved in 3 years. And its growth rate has slowed so much that it clearly says much lower inflation ahead. I know you don't agree with that.
Right.
But it could also be a threat to the economy. I mean, actually, the monetary base has basically stopped growing, and so has M1. Does those money supply measures have any impact on your thinking?
Yeah, I don't. I think for 25 years, the money supply measures have not been good predictors of the economy. Now, they may be today, but that's not what we use in our models. What we use is the federal funds rate versus nominal GDP, and right now that says the Fed's easy. In fact, it never said the Fed was tight. And this is the big difference between today and maybe the early 1990s or the 2001 period or the 1930s. Which everybody is now talking about, the Great Depression again. Those periods of time, the Fed was tight, and that's when credit market problems spread. But today, there's no evidence that the Fed is tight, and that's why I don't think these things will spread.
Nouriel, 2 points well, one that Brian raised. He says you were way too low on Q3, and give you a chance to respond. And I want to ask you about profits in the stock market, because the stock market has held up pretty well despite a rough year by anybody's account with all the subprime credit virus. And as you yourself have noted, asset prices have come down in some key areas, and we have had a credit clogging in the short-term financing market, something that is of great concern to me. But nonetheless, with it all, this is going to be an okay year for stocks. It'll be low single digits in some cases, and tech may be low double digits. And I always believed you got to see a precipitous 15, 20, 25% drop in stocks, Nouriel, before you can make the recession call.
Well, first of all, the S&P 500 might finish a year effectively flat, and that's the most important indicator of the stock market. Secondly, financial and discretionary consumption is down already 10 to 20% in terms of what's happening to the stock market. Third, even in 2001, we had a suckers rally. The economy entered a recession in March, and in May and April, the S&P 500 went up 18%. Why? Everybody thought the Fed is coming to the rescue, and we're going to have second half of the year rebound. It was only in June when people realized, in spite of aggressive Fed easing, we're not going to have that rebound, we're going to have a recession, that the market tanked. I think that we are in the last leg of a suckers rally. Every other financial market, bond market, credit spreads, and so on, are telling you recession ahead.
And
That's what's happening.
One other point. We've had tremendous surging trade exports. Just by themselves, real exports are now about 12.5% of real gross domestic product. It looks to me like that trend is going to continue, Nouriel. Can the export side rescue Goldilocks?
I don't think so. First of all, consumption in the U.S. is 9 trillion. In China is only 1 trillion. And in India is only 500 billion. So there is not enough consumption in the rest of the world to rescue a consumer-led recession. And if you look at all the components of aggregate demand, residential investment is collapsing, capex spending is collapsing, consumption is close to zero. There is not enough net export growth that they can rescue us from a hard landing.
Go ahead, Brian.
Industrial production data, we just had some, was it earlier this week or later last week, tech production was up 16% year over year. The other thing to think about when you look at corporate profits is that if you take away the financials and you take away the home builders, that we know there's problems in those areas, there's huge write-downs, what you find is that corporate profits have been booming. And the other thing is that all these banks are now putting these bonds on their books at extremely low prices. I think next year we're going to have write-ups, not write-downs anymore, because they're putting these bonds on at way below market prices. And that's what I think is confusing a lot of people today, is that the financial markets are pricing in not only the problems we have, but these kind of ephemeral problems, what might happen in the future, and you're ending up with 30-cent price bonds that are really probably worth 75 cents.
Well, actually, I want to buy financials, but that's just my personal point of view.
Losses are going to become much bigger next year.
All right. Just on the way out, gentlemen, Larry Summers, former Treasury Secretary in the Clinton administration, Larry is really in Nouriel's camp. Larry sees recession. Just quickly, gentlemen, Larry wants a tax cut, Brian. I hope you followed this because I want to ask you if you agree with him. It looks like a sort of temporary rebate tax cut to get a bunch of stimulus into the economy. A quick thought, please.
Yeah, well, it didn't work for Jimmy Carter. It doesn't work for Japan. Temporary givebacks and bonuses through the tax system never boost the economy.
Nouriel
I think it's a horrible idea.
Your thought on Larry Summers' approach?
I think it's a good idea. Last two times around we gave tax away to the rich, tax cuts. This time around we have to give it to the middle class, to low-income people. They are crunched right now. They're going to spend it if we give it to them.
Nouriel, the best tax cut I can imagine would be a permanent reduction in corporate tax rates, both large and small, because studies have shown that that would actually, the bulk of that savings would go to wage earners, Nouriel. Your thought?
I don't agree because we cannot afford at this point. We're a structural budget deficit.
Brian Wesbury, I thought the deficit was coming down.
The deficit is coming down, and I think all of this is all about getting the government more involved in the economy. We don't need it. In fact, the more the government is involved, the more problems we're going to have in the future.
Brian, what's your 2008 GDP estimate right now?
We're going to have 3% real growth next year.
And Nouriel, you're what, minus 2% or something like that?
Minus 1.5 for the year.
Gentlemen, thank you very much. Nouriel Roubini, good to have you back. Brian Wesbury, CNBC contributor, good to have you on as always.